Tesla, Q1 2026. 20 Wall Street analysts modeled a cash burn. Tesla printed positive $1.4 billion of free cash flow. That's a $3 billion swing versus what the street was modeling in one quarter. And it wasn't an accounting trick. Operating cash flow came in well above consensus. CapEx came in well below. Both legs moved the right way. Hi everyone, I'm going to walk through Tesla's first quarter of 2026 because underneath that headline, FCF beat, there's one of the most interesting margin stories Tesla has printed in 2 years and a handful of footnote level disclosures that deserve attention. Let's go. The second number that matters, Tesla's gross margin went from 16.3% a year ago to 21.1% this quarter. That's an expansion of 478 basis points, almost 5 full percentage points, year over year. It's the best gross margin Tesla has printed since early 2023, and it happened in a quarter where deliveries only grew 6%. So how do you grow margins 5 points on flattish volume? That's the question the rest of the deck is going to unpack, including how much of it is structural and how much is one-time. Before we touch a single number from this print, you have to understand the question the print is trying to answer, because Tesla isn't valued like a car company. And that fact reshapes how every other number in this deck should be read. Here are the 4 numbers that frame the whole deck. Trailing 12 months, Tesla earned $3.86 billion in net income to common stockholders. For context, Apple, Microsoft, Alphabet, and Meta each printed more than that in this single quarter alone. Annualizing this quarter's GAAP earnings per share gives you a 52-cent run rate. The full year 2026 consensus is $1.10. Either way, Tesla trades at a price-to-earnings multiple that, by every public benchmark, implies far more than the current run rate of earnings. Well above 200 times trailing against an S&P median around 22. The multiple is pricing in Robotaxi, Optimus, AI services, energy storage at scale. Not the cars Tesla is actually shipping today. Every slide that follows is implicitly answering the same question. Did this print narrow that gap or widen it? One quick caveat before we get to the headline. Tesla quietly changed how 3 of its most cited metrics are defined this quarter. The cumulative deliveries number now includes unsupervised robotaxis placed into commercial operation per the 2025 CEO Performance Award. The active FSD subscriptions metric now explicitly excludes free trials, and the operating lease count was restated to new vehicles only. None of these are restatements that flatter the print. They're worth knowing about because quarter-to-quarter comparisons through 2026 aren't apples to apples. And while we're on footnotes, one older one worth reflagging, capital expenditures has been inclusive of energy storage purchases since Q1 of 2025, with all prior periods adjusted. That's a year-old change, but it still affects historical comparisons people quote from before 2025. That's the spirit in which we're going to read the rest of the data. 5 of the 6 numbers we're about to look at are great. One isn't, and it's the one that flows to the headline. 6 numbers. Revenue $22.4 billion, up 16% year over year. Gross margin 21.1%, up 478 basis points. Operating income just under $1 billion, more than doubled. Non-GAAP earnings per share at 41 cents, up 52%. Free cash flow $1.4 billion, more than doubled. But and this is the asterisk, GAAP earnings per share came in at just 13 cents. That's only 8% up year over year, and it's below where the street modeled it. 5 of 6 numbers look great, one of them doesn't, and it's the one that flows through to the headline. We'll come back to why. Let's see where Tesla beat. The vertical line on each row is what the 20 analysts modeled. The bar is the actual print. Revenue beat by roughly $1 billion. Gross profit beat by $1 billion. Operating income beat consensus by 74%. And free cash flow flipped from a modeled cash burn of $1.6 billion to actual generation of $1.4 billion. The operating side of the income statement crushed expectations. The question is why GAAP EPS didn't follow. That's a different story. And the next 2 slides are about that. Operating income up 136%. Net income up 17%. Most of the operating gain got reclaimed below the line. By Bitcoin, FX, and tax. Here's the walk. Tesla's operating income improved by 542 million year over year. That's the plus 136% you see in the headline. But between operating income and net income to common shareholders, the company gave most of that back. Other expense, net went from minus 119 million a year ago to minus 535 million this quarter, a $416 million deterioration. That line captures a $222 million markdown on Tesla's Bitcoin holdings, a $287 million foreign exchange transaction loss, and a small first quarter fair value mark on the new SpaceX equity stake. Add 88 million of higher tax, and the 477 million in net income only grew 17%. Even though the underlying business generated more than twice the operating profit it did a year ago. This is the gap a careful reader has to bridge. Now the other catch. Tesla delivered 358,000 vehicles. Compared to a year ago, that's up 6%, a number that fits the bull narrative. But sequentially, deliveries are down 14% from Q4. The red line on the chart is days of supply, Tesla's vehicle inventory in trading days. It jumped to 27, the highest reading in over a year. And on the cash flow statement, inventory grew by another $2.3 billion this quarter. Tesla produced 408,000 cars and delivered only 358,000. That's the demand soft tell. The year-over-year comparison flatters. The sequential trajectory doesn't. Okay, let's follow the money. Where did every dollar of revenue actually go this quarter? Here's the whole income statement as a flow. $22.4 billion in revenue comes in from the left, $16.2 from autos, $3.7 from services, $2.4 from energy. The red branches are costs. Most of it, roughly $17.7 billion, goes straight out as cost of revenues. What's left is the $4.7 billion in gross profit. From there, R&D and SG&A take another $3.8 billion. Operating income, under $1 billion. And what survives all the way to the right side, net income to common stockholders, is just under $500 million. The margin expansion story is that the red skim got smaller this year. The story the green endpoint tells is that the surviving stream is still extraordinarily thin relative to the size of the company that owns it. Now let's break down the revenue side, 3 segments, 3 totally different stories this quarter. The mix. Automotive is still about 73% of revenue, but the small slices are where the action is. Services and other, almost 17% of the pie, has nearly doubled its share over the last 2 years. And energy, the orange slice, is the only segment that actually shrank year over year. 3 engines, 3 different trajectories. Let's look at each. Automotive revenue came in at $16.2 billion, up 16% year over year. But the margin number is more interesting. On a non-GAAP basis, stripping out regulatory credit revenue, auto gross margin hit 19.2%. That's up from 12.5% a year ago, 670 basis points of improvement on a clean basis. The drivers were higher average selling price as the Model Y refresh and the YL trim rolled out, and lower material costs per vehicle. And here's the subtle one. Regulatory credits contributed 3.7 percentage points to last year's gross margin, but only 1.9 percentage points this quarter. So even with that tailwind fading, X-credit margin still expanded sharply. That's the structural piece worth holding onto. But the segment to watch, the one that quietly broke out this quarter, is services and other. $3.7 billion in revenue, up 42% year over year. That's faster than automotive grew, faster than energy grew. It's the highest margin part of the company, and it's compounding at over 40% a year. What's inside that segment? FSD subscriptions for Analysts. 1.28 million active users, up 51% year over year. And Tesla started moving FSD to subscription only this quarter, which usually compresses growth. But they still saw record net new subscriptions. The supercharging network is 19% larger than a year ago. Tesla Insurance keeps expanding, and the long tail of used cars, service, and parts grows with the install base. Every car that signs up for FSD is paying recurring revenue at near software margins. That's the shape of the business quietly shifting underneath the headline. And now, the dark spot: energy generation and storage. Revenue came in at 2.4 billion, down 12% year over year, but the volume number is uglier. Tesla deployed only 8.8 gigawatt hours of storage. That's down 15% year over year. The street was modeling 14.4, so energy storage missed consensus by 39% on volume. Tesla's explanation is that Megapack 3 is being prepared for start of production later this year at the new Houston facility. That may be true, but the gap between consensus and actual is too large to explain away on transition timing alone. And the bears were right about this one piece of the print. So we've seen the inflows. Now flip to the cost side, because the margin expansion came from somewhere specific, and so did the cash deployed this quarter. Here's the part of the margin story most decks gloss. Management's own MD&A explicitly lists two kinds of driver behind the margin expansion, and you should know about both. On the structural side, lower material cost per vehicle, ASP and mix shift as the refreshed Model Y and the YL trim rolled out, the high-margin services and other growth, and higher deliveries giving operating leverage. Those are the durable pieces. On the one-time or fading side, auto warranty and tariff accrual benefits, similar tariff benefits in energy, a roughly $200 million positive FX impact, and quietly working the other way, regulatory credit revenue falling as a percentage of sales. Some of these one-time items fade in Q2 and Q3. Most of the structural ones don't. The trajectory chart. Gross margin has climbed every quarter for the past year: 16.3, 17.2. 18, 20.1, 21.1. Four straight sequential increases. 478 basis points in 12 months. Adjusted EBITDA margin is up 183 basis points. Operating margin is up 214 basis points. So the operating leverage is real. The question, and this is the honest one, is what happens in Q2 once the tariff and warranty benefits fade. Q2 is the cleaner read. But there's a trade-off. Operating expenses are climbing fast. R&D is up 38% year over year. That's the AI infrastructure spending plus Optimus plus the AI 5-chip program. SG&A is up 47%. And a big chunk of that comes from the 2025 CEO Performance Award stock-based comp, which we'll get to in a few slides. Capital expenditures are up 67%, and the line growing the fastest of all, stock-based comp itself, is up 80% year over year. The margin expansion is funding all of this, but only just. Capital expenditures, $2.5 billion in one quarter alone. That's been the run rate for 4 straight quarters. Cortex-2, the AI training cluster, is ramping past 130,000 H100 equivalent GPUs. New battery cells in Nevada, cathode material in Texas, lithium refining in Texas, all ramping. The Optimus first-generation production line is being installed in Fremont right now. Annualize this run rate and you're at $10 billion of CapEx for the year, against $4 billion of net income. Q1's FCF surprise is real, but the underlying CapEx bill is just as real. And then there's this. Buried in the cash flow statement is a brand new line item. Purchase of SpaceX equity investment, $2 billion. Tesla, the car company, took $2 billion of cash and bought equity in SpaceX. This is the first time that's appeared on Tesla's books. It's roughly twice the quarter's operating income. That's not the only thing worth knowing. The accounting treatment matters too. Let's unpack what that $2 billion is, mechanically. It's a related party transaction. Elon Musk is the CEO of both companies, so Tesla doesn't have control over SpaceX, just significant influence. The accounting treatment is the fair value option under ASC 825, meaning Tesla will mark this investment to market every single quarter, and the gains or losses flow through the same P&L line as the Bitcoin markdown we just talked about. The carrying value today is $2.002 billion, classified as level 2. Market observable inputs, but not exchange traded. The stated rationale quoted from the update is that the partnership aims to build, quote, the largest chip fab ever, end quote. The filing doesn't decompose the rationale further, whether you find that compelling or not. The mechanics now create a quarterly volatility item on Tesla's income statement that didn't exist a quarter ago. And while we're on disclosures, this is the one most decks skip. The 2025 CEO Performance Award, granted in Q4 of last year, approved by shareholders in November, 423.7 million restricted shares to Elon Musk, roughly 11% of shares outstanding, 12 tranches keyed to market cap milestones from 2 trillion all the way up to 8.5 trillion. As of this quarter, Tesla has marked the first operational milestone, 20 million vehicles delivered as probable. That unlocks $9.97 billion of unrecognized stock-based comp to be amortized over 9.4 years. 260 million of that hit SG&A this quarter. And here's the part that doesn't get enough attention. There's another $105 to $120 billion of stock-based comp that's not yet considered probable. If more milestones get marked probable in coming quarters, the SBC line ramps further. The aggregate potential cost of this award dwarfs Tesla's trailing 4 years of net income. That's the dilution overhang the multiple has to grow into. One more line worth flagging: long-term debt, net of the current portion, went from $5.3 billion a year ago to $7.8 billion this quarter, up 47%. Tesla issued $4.3 billion of new debt in Q1 alone. Yes, the company still has $44.7 billion of cash, so the balance sheet isn't stretched. But this is the third quarter in a row where Tesla has taken on more debt than it paid back. A company that historically funded itself out of cash flow is now quietly leaning on the debt markets. That's a phase change worth naming. Okay, last data section. What is Tesla actually planning to deliver the rest of this year, and what does each bet need to hit? 5 products are supposed to hit volume production over the next 12 months. Cybercab and Tesla Semi are both meant to start volume production this year. That's a bold claim, since Cybercab hasn't shipped a revenue unit yet and Semi is still in pilot volumes. Megapack 3 is targeted for later this year at the new Houston facility. The first Optimus production line is being installed right now. And the AI5 inference chip, which Tesla just finished designing in April, is on track for sometime in 2027. That's the runway. The question is whether each of these clears the bar that justifies the multiple we talked about at the start. The Robotaxi service is still small in absolute terms, about 1.7 million cumulative paid miles to date, but paid miles nearly doubled sequentially this quarter. Unsupervised rides launched in Dallas and Houston in April. The Austin operating area expanded again. Tesla has preparations underway in 5 more U.S. metros: Phoenix, Miami, Orlando, Tampa, and Las Vegas, plus the SF Bay Area operating under a safety driver permit. The FSD software just shipped version 14.3 with reinforcement learning training and 20% lower inference latency. The absolute mileage is small. The shape of the curve is the right one. Whether it scales into actual unit economics is the question that matters for the next 4 quarters. And then there's this. The update says the first generation Optimus production line will be designed for 1 million humanoid robots a year. It's going into Fremont, replacing the Model S and Model X production lines. The second generation line, being prepared for Gigafactory Texas, is being designed for 10 million robots a year. 10 million. These are not numbers that are going to print this year or next, but they tell you where management's mental model has shifted to. And they're one of the operational milestones in the CEO Performance Award we just looked at. So, what do you do with all of this? Rather than score the bull and bear cases against each other, let's frame each as a set of falsifiable conditions and then map what Q1 made more or less likely. The bull case isn't a vibe, it's 5 testable conditions. Margin has to hold above 20% once the tariff and warranty one-time benefits fade. Services and other has to keep compounding in the 30 to 40% range. Cybercab and Semi have to actually reach volume production this year and earn revenue. Robotaxi has to scale beyond 3 metros into something resembling a real fleet by 2027. And Optimus has to clear unit economics before the SBC overhang compounds. The bear case has the same shape, 5 conditions. Demand softness persists, inventory keeps building, ASP slides. X-tariff margin reverts in Q2 and Q3. Energy storage stays below trend through 2026. CapEx absorption fails, Cybercab and Semi slip again, $10 billion a year of CapEx against $4 billion of net income. And dilution accelerates as more CEO award milestones get marked probable. 5 on 5. Now let's map this quarter onto them. Here's the map. On the bull side, the margin trajectory and the services and other growth are both clearly advancing. Those are the strongest signals in the print. On the yellow side, the delivery and inventory imbalance is real, and the CapEx absorption only works if Cybercab and Semi actually start earning. Two bear conditions visibly advanced. Energy storage volumes came in well below where the street modeled them, and the first CEO Performance Award milestone got marked probable, unlocking $10 billion of SBC over the coming 9 years. And the SpaceX equity stake is a wild card. Neutral now, but the next 2 quarters of fair value marks will tell. What you watch over the next 4 quarters depends on which of these conditions matters most to your framework. None of them are resolved yet. If you take one thing away from this quarter, take this. Tesla delivered roughly the same number of cars as a year ago, 6% more, 14% fewer than last quarter. But the margin on each one nearly doubled. That gap between flat volumes and surging profitability is the whole deck. The bull case says the margin holds and the volume comes back. The bear case says the margin reverts and the volume keeps softening. The next 4 quarters tell us which. Now, that's the Tesla Q1 2026 story. If you found this breakdown useful, hit subscribe so the next one lands in your feed. Earnings season never really stops, and we run every major print through the same framework. Footnotes and all. Numbers first, narrative second. One question for you in the comments. Which of those 5 bull or bear conditions do you think matters most for the next 4 quarters? See you next video.